Welcome everyone to session 4 of the webinar series on challenges, lessons, and innovations for integrated flood risk management. This is an event organized as part of the Asian Development Bank's Knowledge Support and Technical Assistance Project, Strengthening Integrated Flood Risk Management. I'm Lorena Ramirez, Senior Water Specialist from London Mills, and the Project Manager, and I will be moderating today's session. Please note that this meeting is being recorded, and there are also two language channels providing simultaneous interpretation to Bahasa and Vietnamese. Please, Guillaume, could we share the slides, please? Thank you. This session will last for 90 minutes, which will include two presentations, one on economics analysis for integrated flood risk management, and the second one will be on the role of flood insurance for post-disaster recovery. Thank you, Guillaume. Could we pass the next slide, please? After this, the presentations, we will hold a discussion on Q&A, session. So please submit your questions during the session via the chat box, and we will compile them and go through them at the end. Before moving to the presentations, we will start the session with opening remarks from the Asian Development Bank. I'm pleased to introduce Jinming Huang, who is the Director of the Urban Development and Water Division in the Pacific Department of ADB. She has 30 years of experience, including 13 years with the Asian Development Bank in the fields of urban planning, water, wastewater, solid waste management, as well as project development. Jinming supports the division to focus on sustainable urban and water service delivery in Pacific Island countries, but working closely with governments and development partners on technical, safeguard, financial management, and procurement issues. She also plays a major role in developing knowledge products and best practices in the sector, both within and outside ADB. Over to you, Jinming. Thank you.
Thank you. Thank you, Lorena. Good afternoon, good evening, and good morning to all of you. Welcome to this session 4, Economic Analysis for Flood Risk Management Project, the role of insurance and reinsurance in flood risk management. It is my great honor to do this opening remarks. As we all know, the water-related disasters are very common in Asia, due to this rapid urbanization and high population density in Asia. Normally, the financing of water-related disaster risk management is done either by the respective national and sub-regional, subnational governments or external agencies, including the insurance companies. Even without the climate change, many regions already require significant investment on flood risk management. And it is always an important component of our Asian Development Bank's water operation portfolio. The climate change in Asia would transform into more intense raining seasons and more floods. According to the World Water Assessment Program, climate change is costing the world between 5 and 20% of GDP each year. And about the flood risk, a report by McKinsey highlighted the flood risk due to climate change as the economic impact is greater in Asia than anywhere else. It estimates that by 2050, 70% of global capital stock at risk from flooding would be in Asia. In 2021, ADB elevated our ambition to deliver climate financing to $100 billion over the 2019 to 2030 period, with $66 billion for climate mitigation financing and $34 billion for scaling up the transformative adaptation projects and enhanced resilience. To build climate change resilience in water sector, definitely would require more investment in water resource development and coastal, river, and urban flood risk mitigation measures, so we can minimize the climate change impacts on water infrastructure. Therefore, it is very important to use different financing tools, including the insurance, to encourage more climate resilient flood risk management. And also, I just want to add, based on our experience in Asian and Pacific cities, when we do the integrated flood risk management, we should also consider the nexus of flood and solid waste. As in many cities, randomly dumped solid waste blocks the river flow and reduces the flood capacity. This also reduces the benefit of investment in flood risk management. I can see there are so many interesting topics we can discuss about the role of insurance in the integrated flood risk management. I really look forward to this session. Thank you. I hand it back to Lorena. Thank you very much.
Thank you for your words, Jingming. Next, I would like to pass it over to Ian Wood, who is the team leader and climate change specialist to the Knowledge Support and Technical Assistance Project and Strengthening Integrated Flood Risk Management. Ian Wood has over 35 years of experience working in the water resources and flood management sectors, and over half of the experience has been in Southeast Asia. Working on projects with donor agencies, Ian Wood can offer some insights on the many practical aspects for implementing flood risk and disaster management programs. Over to you, Ian.
Yeah, can we go to the next slide, please? Thank you for the introduction, and thank you, Jingming, for the introductory remarks as well, giving us some context from the point of view of ADB. So just overall, this is a KSTA project, Knowledge Support Technical Assistance on Strengthening Integrated Flood Risk Management. The project we commenced in February 2019, and we conclude later this year in June. The scope of the project is 8 countries in South Asia and Southeast Asia. So that's Indonesia, Philippines, Vietnam, Myanmar, Bangladesh, India, Nepal, and Pakistan. Just on this slide also, we have the logos at the top. So Landell Mills and JBA Consulting, the implementing consultants for the TA. And of course, then we're working with ADB directly, but the whole project itself is being funded from the Urban Climate Change Resilience Trust Fund, which is a trust fund being managed by the Asian Development Bank, which receives funding itself from the Rockefeller Foundation and from the governments of Switzerland and government of the UK as well. So if we go to the next slide, what we've been doing is a series of 5 webinars. This is number 4. And today is on economic and finance, but previously we've dealt with other issues for IFRM at a global scale, at a more river basin level. We look specifically at coastal flood risk management issues. And then this one is economic and finance, but then next week on 5th of April, our last one is more a general outlook and ways forward discussion forum. And we'll talk more about that at the end of this presentation as well. The overall objective for the webinar series is to be basically to share our experiences from implementing this KSTA project and to reflect on the issues and lessons learned in applying our IFRM in the practical applications. And so what I mean by that is that some elements of the TA have been about identifying knowledge and packaging this and producing knowledge products on different issues related to flooding. Finance is one. Economics is another, and insurance and so on. So we have many different knowledge products that we've prepared to developed and shared through this program. In addition to that, we've been conducting specific activities in support of ADB, in support of project preparation for ADB as well. So through all of that, we've gained some experience and some knowledge, really focusing on IFRM. And so this webinar series is all about sharing that to a broader audience. So I wish everyone an enjoyable webinar, and we look forward to receiving your questions at the end, because this is really about what we can learn from this, and through that Q&A we can really get, we can hear your point of view, your ideas, and and your questions and get our experts to be able to answer them. So thanks, Lorena.
Thank you, Ian. Next, I would like to introduce the first speaker of today's session, Guillaume Dulac. Guillaume is a water and environmental engineer and economist with over 15 years of experience in international project development. Guillaume works with development finance institutions to inform project design and packaging, such as economics and quantitative risk analysis at project appraisal stage. His work draws from a variety of sources, including quantitative analysis, such as probabilistic modeling, political economy, social fabric, or security analysis, contextualized to data scarce and uncertain environments. This holistic approach led him to develop an independent understanding and insights of complex cost-benefit analysis. Over to you, Guillaume, for the presentation. Thank you.
Okay, thank you, Lorena. Thanks, everyone. So this is a relatively short presentation of about like 20-25 minutes, where I would like to basically throw some critical questions that are relevant to the economics of flood management, and try and show how these general critical questions are linked with some of the nitty-gritty work that the economists are doing in the context of development banking. So I'll go through a few points, but before that, just to start with I'd like to start with and engage with the audience. So if Patagonia can throw in the poll question 1, please. The poll question is, what's the main driver of flood losses? So you have a number of choices there, but you see, you can only pick one. I realize this is a little bit of a limitation, but it's just to get a feel of your first intuition, and we'll discuss that. We'll just give the audience a few more seconds to make a choice. Okay, well, let's hope that you all have chosen an answer. So if Patagonia can close the poll and display the results for us, please. Okay, what do we have here? The 26%, so urbanization, lack of infrastructure, and flood patterns. Okay. Okay, well, that's interesting. So a little bit of success for commodity prices and climate change. If we can, if we can close this, I basically asked this question just to remind a basic definition, which is that of risk, and put it in the context of disaster risk management. So, you know, in general and across industries, the risk is the possibility of a loss, and it translates in the arena of disaster risk management, and hence in flood risk management, oftentimes in basically 3 components, which are the exposure, hazard, and vulnerability. So it's a sort of a well-known result that the main driver is really on the exposure and vulnerability side. So basically, if we try to relate this to the question, it was sort of obvious that lack of infrastructure was more on the vulnerability side, together with commodity prices. I'll come back on that in a second. Climate change was more on hazard. Urbanization is sort of both exposure and vulnerability. and the lack of understanding of flood patterns is really pertains to vulnerability. I think it's a good starting point. So first of all, I'm glad that urbanization came first, because this is consistent with this general result that we know about risk in general. It's also consistent that even though it's fair to give a good success to climate change, it doesn't come first because that pertains to hazard. On the commodity prices, it's a bit of a trick because it's basically a vulnerability thing. You know, if it really is dependent on the connectivity of markets and the market responses. If you get your crop flooded, maybe the price will drastically increase if your market is not too connected to the rest of the world. And therefore, you may not be that affected in terms of economic value on the paper, but it will affect you because the distribution of the value will have consequences. Because, you know, the price basically maybe of the wheat or rice is going to be more expensive. So the total economic value can be the same, but it can be just more expensive to purchase. So in this slide, there are just the sort of the general key topics we're going to discuss. In I wanted to first sort of clarify and hopefully agree with you that you know, which are the key features that we have in development banking when we're doing integrated fraud risk management economics. So one key feature is that we're dealing with very long-term horizon, right? 20 to 50 years is the ballpark, really. This is typical of a public perspective. You know, if you're doing, you know, private ventures, the time horizon are much, much shorter. And it's also a time horizon that is consistent with the integration of climate change, more 50 years than 20 years, but it allows to make this sort of consideration. Now, with long-term horizon come a number of uncertainty, because you have to speculate on, you know, how the world is going to be in 20 or 50 years. In addition, with the inherent uncertainty that you get in any disaster risk management project. You know, by essence, you don't know when a disaster is going to strike. So, well, that's where risk analysis and quantitative risk analysis is relevant and is a tool that you can use to try and deal with these uncertainties and try to handle them as much as you can. Another feature which is sort of specific to the aid industry, I guess, development banking, is that, well, I mean, as in any industry, you know, you have to, you know, banks are banks, you know, their job is to lend money. I mean, they have a mandate that is not obviously strictly commercial, but it materializes in making loans or grants. But it's basically, you know, closing operation. And to that extent, it's very similar to what you can find in the private sector. So you have this sort of tension, which can be actually healthy, but on the one hand, you have a very complex topic that you have to deal with all these uncertainties and so forth. And on the other, you have the constraint of, you know, limited timeline, lending the operation, as they say in the ADB very commonly, with a form of very standardized expectation, you know, all this documentation for a project approval that's going to the board and so forth. You know, they process hundreds of projects every year. So obviously they require some form of standardization. And sometimes you can have, let's say, a tension between the fact that on the one hand, you have to give something, very neat and very formalized and not that flexible in its format, and the fact that you have to think of a very complex topic where you need some, room for freedom. So the economic analysis lies in the middle of this and have to sort of try and reconcile these different constraints. And that means that, an economic analysis, so long as it is quantitative, and it has to be to a certain extent, you will have to provide some kind of modeling. Modeling is a big word, but it's just let's say, a quantitative representation of what's at stake. And that means that you will have to deal between, you have a trade-off basically between the robustness of the model and its accuracy. So the more you want to be accurate and precise, the less thing your model can consider and encapsulate. On the other hand, if you want your model to account for a number of topics and reflect the complexities that I've just been mentioning, then it becomes more and more difficult to be certain of your results, and then you lose in robustness. So you have to find a sort of optimal point. And it means that you have critical modeling choices to do, because you have a limited time, a limited level of effort. Any of these topics, econ analysis on flood project, you could do a PhD thesis on any of them, but you don't have that luxury. So you have to make critical choices. And therefore, another important topic is to be able to make, to choose, you have to choose your fights. You cannot investigate every avenue that is relevant. So part of the game is to what I call maximize the value of information. It's a bit of a pedantic statement, just to say that you basically have to put the effort where it pays off the most in terms of reducing the uncertainty and bringing relevant information to inform the decision making. And as it happens, it turns out that the economic thinking, you need to develop a sort of, you have questions of your own that may not be exactly the same center of interest. Well, the center of gravity of the economic interest might not exactly coincide with the center of gravity of interest of the engineers you're going to be working with. Obviously, these are projects entailing a lot of engineering, but engineers have questions of their own because they have to deal with their issues. But it's not necessarily the case that their area of focus are the one that are the most prevalent in economics. So you need to have some form of to allow yourself some freedom of thoughts in that regard, and hopefully we'll see in practically what that means. So I can try and move to the next slide. Yeah. So again, I'm going to go fairly quickly, and we can discuss anything during the question session. But really the key essentials about IFRM economics is that, well, first of all, you don't have benefits as money that goes into a bank account. It's avoided damages, and it necessarily comes with with the question of compared to what. So you have a project and you have a baseline. So you need the first important thing is to set these two things. My project, I have an idea of doing something, you know, dikes, early warning system, institutional reform, whatever. It's a project. How does that compare with the baseline? And you have to remember, it's not only now that it matters, but in the next 20 or 50 years, up to your horizon of your project, because, you know, you have to integrate things throughout time. Another key topic you have to keep in mind is this economic versus finance. And I'm going to not insist on this because ADB does, and rightfully so, but it's about the O&M. I mean, they represent a significant yet minority share of all the costs, but they are absolutely central. You know, if as you're increasing the level of asset that you have, you're also committing for more public expenses. Otherwise, you cannot run these assets and they go down the drain. Yeah, no pun intended, with respect to flood management. The third, which is principle, which I find is really key and relate to robustness that I was mentioning before, is to adopt a conservative approach, which means avoid overestimating benefits. Why would you want to do that? You want to do that because you don't want anyone to challenge that the fact that you're coming up with a good economic indicators is actually too uncertain. So you want to come up with an conservative estimate of the benefits in order to have yet good enough economic indicators as just to say, look, even considering only some share of the benefits, the project has some economic rationale. And that's a sort of a robust conclusion that helps to defend the project in terms of, you know, competition for allocation of public money. And you have basically two ways of avoiding these overestimate of benefits. One is on the perimeter of the benefits you're considering, you know, so you can consider, for example, benefits in a number of sectors. You may, for example, limit the number of sectors, or you may limit the depth of the benefits. So, for example, in a direct, in any sector, you know, you have direct impacts and indirect impacts. You know, for example, if a road is impaired because of a flooding, let's say that the direct impact would be the cost for, you know, fixing the road. But you also have more indirect effect, is that if the road cannot be used for, I don't know, a week, then you lose a number of economic opportunities. So these are essentially the two ways in which you can limit your approach. And all the trade-off, as I was discussing before, is still limited enough to be robust, but at the same time, you don't want just to focus on what you know how to do. The final model needs to make sense. So, okay, this is just to put a little bit of the symbols and colors. I'm not going to go into the detail. The thing is, I want to talk about AAL because this is just the main metric. It's called annual average losses, and it's the metric that is very much used across disaster risk management industry to get some insight about the current state of disaster impact and what can and the extent to which a given project can mitigate the risk. So essentially, as it's stated in the name, the AAL is an average. It's called a mathematical expectation of damages. So it's basically, if you were to look over a very long-term horizon, you know, those damages are going to come, some years you're going to have no disasters, and then all of a sudden you're going to have a very severe one. So it's a very intuitive concept. It's basically saying, on average, if it was the same cost every year, how much would that be? And it turns out that we can have relatively simple representation of these. So it looks complicated, but it's actually fairly simple to be dealt with within sort of any Excel table. The benefit that you will get from a given project, is going to be a difference between the project scenario, so implementing those things that you're thinking about, and the baseline, i.e. current situation. So in this, the difference is the orange part in one of the figures in the upper right figure that you see. So this figure is illustrate basically the damages as a function of the return period, or if you like, it's an expression of how likely a given disaster is. And it's the difference between the current damages that are higher if you don't do anything, with the damages that you will still get, because even if you implement some measure, you will still have some risk. And the difference between the two is your avoided damages, i.e. benefits. Now, that's the general thing. A word I want to have, because this is fundamental and this is somehow ignored, this is what the bottom figure says. It's that there is a very important thing, and again, it's true for the flood industries and in general in most of the risk typologies, is that actually the AAL, so your average, is essentially made of recurrent damages, meaning that overall, in the grand scheme of things, very recurrent floods of relatively small impact have overall more impact than those very rare floods that are devastating. It may be counterintuitive, especially because people, when they think of flood, they remember the big events. But the truth is, because the rare events are by definition rare and don't happen so often, if you take their contribution for every year, it turns out to be slow. And what this curve says is that if you change, it's basically the AAL, the final result, which is really the key ingredient in this analysis, they are much more sensitive on low return period events, i.e. frequent events, than it is for rare events. And one of the immediate conclusion that you want to have when you're doing an economic analysis is that you want to reduce the uncertainty, more importantly, on those frequent events that's on large events. And that's an illustration of what one of the things I was mentioning earlier, which is a difference in interest, for example, that you may have with engineers. I mean, rightfully so, hydrologists, these specialists are very interesting. One of their key questions, and it's a very important question, they are busy, wondering how to model these disasters, and they are very much interested in high return periods. They want to understand how is the 50-year, 100-year return period flood going to look like. And that's a very legit question and very interesting. But nonetheless, if you are interested in economics, really what matters the most is the change on low return periods. And the same, if you have a project, you are really you really want to get an understanding, it's more important if you have to choose, everything is important, but if you have to choose, it's more important to understand the impact of your project on high frequency events than on black swans, for example. Now, other important questions. The time factor. Well, I've discussed this a little bit. One of the key things is that relates to time, the way it is captured in the economic analysis is through the discount rate. So the discount rate is basically a number that parameterizes, that basically allows one to, compares apples to apples and not apples to oranges, meaning that $1 of saving now is not the same thing as $1 saved in 10 years, because the world will be different in 10 years. So the discount rate is an extremely central notion throughout economics, any project at all. It's a huge literature associated with this. It's quite complex, which is why also you have in development banking, you usually have policies, and in ADB, it's quite simple. They've simplified this for us. We have the choice between two discount rates. It's either 9%, which is the rule by default for most projects, or it is 6%. You have to discuss this with ADB to make sure they allow you to do that in specific project, but IFRM project are eligible. But basically, project with high environmental impact or high relevance to poor segments of the population are eligible to lower discount rate. When you have a lower discount rate, it's basically easier to claim an economic rationale. On the time factor, the second point I want to discuss, just mention this, it's what I call hitting a moving target. It's an extremely important thing that I find is completely overlooked in most econ analysis. This is not only relevant to disaster risk management, it's any econ analysis. Basically, let me make this simple for you. And I think you already have an understanding of this because you answered urbanization, you ranked urbanization first in the poll. If you have a project that protects let's say a city center where there is now 100,000 inhabitants, if in 20 years you have double or triple that amount of people, even though you are going to discount those results, meaning that they are going to mean less because they happen in 20 years, it turns out that if the population is in the meantime multiplied by 2 or 3, then the damages and hence the savings are going to be much higher as well. So it's very important to try and understand these dynamics. It is obviously very speculative, but it's really important to try and do that, because otherwise you're really missing an important driver of things. It's easy to focus. It's a typical pitfall of modeling to focus on the things that you know how to model. It doesn't mean that it's the most important. If you lose your key, you may as well search them where there is light. But I will still advise you to first think, where is it most likely that you lost them, and try to search them, even if it's in the dark, but likely to be found, rather than search wherever you have light, even if it's convenient, if this is unlikely that you find them. The other on sector analysis, I have to go very quickly on this because it can get very technical, but you basically have two types of method. One category is what I call surface-based method. And it's basically relevant to understanding the damages that you get on property, on agriculture. that's where the interaction is sort of very natural with engineers. You know, they give you those inundation map, and you say, okay, there is that many hectares with half a meter of water, and that many hectares with 1 meter of water, and you know the square meter of the property in that area is worth that much, and da 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 da. Or if I lose that many the hectares of you know, paddy crop, given that the unit value on the market is that much, then I'm losing that much. So surface-based methods, that's where the interaction with engineers is the most natural and valuable, and this is absolutely central. Other thing is traffic-based methods. It's usually when you look into more indirect effects, but that's sometimes necessary. It's typically the case for transport or utilities. So why? Well, traffic for transport is understandable. You know, a road is cut or an airport doesn't work, then you don't have that economic traffic, and you can try to quantify that. And basically, oftentimes using the value of time of the people. So you're going to try and quantify how many people did not travel, what's the value of their time, and so forth. Or for utilities alike, you know, if a power plant is impaired and cannot generate electricity for X days, then you have to find the value of this missed productivity and missed welfare associated with this energy traffic that you didn't get. So that's traffic. Pretty much any loss can be conveniently mapped onto either surface-based or traffic-based issue. But each of them can be discussed very lengthily, but that's not the purpose here. I think what I just want to stress here is just a few questions that are relevant to each of these points. Well, first of all, you have to think in terms of, and again, you have to think about this in terms of time constraints. You don't have the luxury of doing everything by the book. So one thing is, do I have primary data? The answer is definitely no. Okay, second, to what extent can I rely on literature? And if you want to rely on literature, another very relevant question would be, to what extent is this legitimate? Replacement cost versus new. There is also an issue if you want to count indirect effects, because it's true that they are much higher on low frequency events. And another very important point is distributional effects. You know, you're talking of losses for the public in general, but it's really not the same to lose $1 if you're poor or rich, obviously.
Sorry to interrupt, Guillaume. I just wanted to say that we're running a bit late, so if we could just take 1 minute for this slide, that would be great.
Yeah,
Thank you.
Yeah. That's the last slide. I'm closing it off. So the last thing you can discuss in economic analysis is our fatalities. I want to say that within the aid industry, it's quite controversial, but there's a way around that. You can quantify the missed economic productivity. There is only one model basically in the literature, not many models, but you can try and adjust this on a case-by-case basis. It's a model that was fitted for England, but so it requires a little bit of expert judgment to see whether it's appropriate. And another thing that I don't have time to discuss here, but it's early warning system. It's, you know, develop some specific modeling to understand the value of conveying relevant information about disaster timely to people. So these are the formula that are displayed, which I'm not going to discuss, but they basically relate to that, and that's something that can be interesting to contemplate, even though it's not a very common practice, unfortunately, in the aid industry. So now I would like just to close this and have the second poll question, if Patagonia can put on the second poll question, please. So the second poll question is, what's the most effective way to mitigate economic losses from flooding? And again, you have to make a strict discrimination between a few options. And I'm not going to entirely discuss this right now. Maybe it can come up during the question session. I'll just give an outline here and then pass on to Jane. So I'll just give you a couple of more seconds to make a choice. I'm actually very interested to see how you answer this. Okay, if Katagon, you can please close the poll and display the results. Okay, land use, infra, NBS, and EWS. Oh, insurance has a little success, too bad. Okay, thanks. I'll just say a few things before handing into to Jane. I just want to see how does that relate to what we've been discussing. So basically, in a nutshell, and again, this is only my opinion and we can discuss that. Infrastructure, I will say that it's very effective. Well, obviously assuming there is exposure, but it's kind of expensive, obviously. But that's the measures that can yield the most benefit, but it comes at high cost. It's a bit the contrary to early warning system, which are efficient, which is not quite the same thing. It means that they have a potential for reducing the damages that is important, but not so huge. But it is comparatively very cheap, meaning for $1, you would get more. So it's more efficient, but less effective, EWS. I think you're not giving justice to insurance, but I reckon it's not easy to understand because it needs a sleight of hand if you look at it from the economic perspective. And that has basically to do with the fact that after a crisis, $1 is worth more than $1. I mean, if you look at it from the economic perspective, the very fact that there is an insurance industry means that the premiums added all together have to be higher than the AAL. So in theory, and if you look only that way, it's not a very good thing to do. But obviously, managing the cash flow has some value. And having some money when you face a disaster, that money is worth more. This is a little bit documented. We lack somehow a little bit evidence, and data is difficult to gather, but that's a fact for sure. And on regulation and land planning, I'll club them together and just say one thing. It is very effective financially because it doesn't cost much. But is it economically? Well, that depends on a critical notion of economics, which is called the opportunity cost. And I will relate these two solutions to also distributional aspects, because it's very easy to forbid people to build houses in floodplain areas. But if you do that, and that you prevent them from being in a city, for example, where they can find a job, then there will be also a big economic opportunity that is missed for them. So it's quite a controversial topic as well as a very interesting one. Maybe we'll have the opportunity to discuss that later if you are interested. So I think I'll just pass on to Jane now.
Thank you, Guillaume. I'll introduce Jane before passing it to her. Dr. Jane Tuthi holds a BSc and PhD in Natural Hazards Studies and has over 20 years of experience in the modeling of flood hazards to assess financial losses and to support the development of financial mechanisms, particularly in the insurance sector. Jane is a Jeremy Benz Associate Director for his specialty insurance and reinsurance business, which has developed global flood models, CAT models, and financial loss models, including Bangladesh, India, Indonesia, Myanmar, Nepal, Pakistan, Philippines, and Vietnam. She has led the development of a wide range of analytics, models, and software systems designed to evaluate the cause of flooding and the different flood resilience, vulnerability, and climate scenarios. Jane has recently led a recent project for the World Bank investigating available data and approaches for formulating disaster risk financing mechanisms in Asia. Over to you, Jane. Thank you.
Thank you, Lorena. Thank you, Guillaume, and welcome everyone to the second part of today's webinar. I'm here to talk to you about insurance and the role it can play in recovery following flood events. The results of the poll were very interesting, and Guillaume, thank you for the quick introduction to insurance following that. I think it's very fair to say that insurance cannot prevent losses from happening. The role of insurance is rather with dealing with the immediate post-event cash flow situation that is there, and helping alleviate cash pressures on governments following a major catastrophe event. And some of that is really what I would like to come on to talk about today, with reference to 3 countries that have seen flooding in the past 11 or 12 years. Next slide, please, Guillaume. So in a little bit more detail, I'm going to start by giving an overview of flooding and the insurance markets in each of Thailand, Germany, and the UK. I'm then going to come on to the basics of insurance and why it's beneficial, and then to talk a little bit about insurance penetration and some of the things that might encourage or discourage individuals from taking up household insurance against flood. And finally, I'll talk a little bit about possible ways forwards for countries seeking to increase the take-up of insurance. So next slide, please, Guillaume. I will start in Thailand. Thailand, as many of you will know, suffered catastrophic losses in 2011 due to flooding on the Chao Phraya River, which runs north to south through the country, eventually running out to sea by Bangkok, as shown in this diagram. The blue shaded area on this map shows the extent of flooding during the event, and the red to green shaded areas show the extent of losses during the floods. So you can see that many of the losses were concentrated not in the urbanized area of Bangkok, but actually out to the north of the city. And this was because of flooding of just 7 large industrial sites located in that area. Although losses did occur to residential and commercial businesses during the flood, losses to industrial properties, even just at these 7 sites, were far greater than losses to residential and commercial properties, and took up around 70% of the total loss. In total, the economic damage of this event was estimated to be $46.5 billion, and of that portion, insurers picked up $15 billion. Rehabilitation and reconstruction costs have been estimated to be a similar amount again to the total loss, or even slightly higher. So you can see very easily the scale of the financial problem that the Thai government faced after this event. In terms of the residential and small commercial properties, unfortunately, insurance wasn't able to help quite as much there, largely because the take-up of insurance in Thailand is quite low, at around about 1.9%. Mercifully, though, those large industrial sites that were flooded were well insured, and that's why the insurance pickup of damage following this event was as large as it managed. Next slide, please, Guillaume. Next comes Germany. So Germany sees significant river flooding with a reasonable frequency. In 2002, the Elbe and Danube in the east and southeast of the country were flooded in what some at the time referred to as the flood of the century. But I think that estimate was very misplaced, and indeed flooding occurred again in very much the same area in 2013. the table I'm showing at the bottom here presents losses from those events. And as you can see, all of Germany's major rivers flow through other countries, so losses aren't just limited to Germany in this case. The cost of these two events was each around 15 to 20 billion, with the insured portion of the loss settling out at between 2 and 4 billion. That's a very similar proportion for the insurance industry to pick up, as was the case in the Thai flooding in 2011. From a flood risk management perspective, there's some interest in comparing the location of damage during these two events, which gave rise to high flows on very similar parts of the river system. But following the 2002 event, there was a significant amount of flood mitigation work carried out, and that work proved quite effective in the 2013 event, so that the general pattern of losses in 2013 was geographically somewhat different. So many of the areas protected in between the two events were not flooded in 2013, but what happened then was that flooding rather occurred in areas that hadn't been protected since the 2002 events and hadn't seen defence improvements. That in turn led to further improvements in defences in the area since 2013. But unfortunately, the next really major flood to occur in Germany in July last year occurred further to the west. This time, the flooding was concentrated on smaller river systems that fall within the Rhine catchment and in the west of the country. It was caused by a similar weather pattern to the 2002 and 2013 events, but the flooding that occurred seemed to take scientists, insurers, and the population alike by surprise. The flooding occurred in the small river systems with steeper catchments, and as a result, the flooding that resulted was very high velocity and caused very severe damage. Our figures suggest that some of the flows recorded during that event reached the 300-year return period level. With its significant history of river flooding, Germany has a good river flood defence system in place. But like I've said, a lot of the work on that was concentrated in the east of the countries on the areas that flooded in 2002 and 2013. In 2021, the total damage was estimated to be 53 billion. And again, a relatively small proportion of that was insured, around $13 billion. However, the proportion of insurance associated with each different line of business, be it residential, commercial or industrial in this event, was quite different. So the residential and commercial properties picked up a good proportion of the insurance as well as the industrial sector. And in general, the losses weren't as focused on the industrial sector as was the case in Thailand. Next slide, please, Graham. So finally, we come to the UK, and I show here a map of the river systems in the UK. Flooding is very, very frequent in the UK, and it's almost difficult to limit the list of years when there hasn't been quite significant flooding. With a large coastline and a wet climate, the UK is at risk to all of river surface water and coastal flooding. And the average cost of flooding here is estimated to be between 450 million and 1.3 million dollars, depending on the source that you look at. The floods tend to be a little bit smaller than we see in Thailand or Germany, though. Flooding in 2007 was perhaps the most severe event we've seen in the last few years, and we estimate that if that event was to recur today, it would cost between 4.5 and $7 billion. Flood defence spending is also very high, given the frequency of flooding, and at an estimated 3 billion a year, it's actually somewhat higher than the average annual cost of flooding. And flood defence spending, construction and maintenance is a big political topic in the UK. Likewise, with flooding so frequent and very much in everyone's mind, the take-up of flood insurance is also extremely high. Flood is included as standard in most insurance policies, and as long as the premium is affordable to the homeowner, it's very rare that an individual would choose not to have flood insurance for their home. This situation's a little bit different to Thailand and Germany, where flood is available as an add-on to homeowner policies and needs to be paid for specifically. So with that, let's come on and think a little bit more about insurance. And if we can move to the next slide, please, Guillaume. At its most basic level, an insurance contract or policy is written between an individual and an insurer, and it's an agreement in which an insurance company agrees to pay compensation following an event in return for the individual paying an annual premium. If you like, it's the acceptance of risk in return for a premium. The benefits of insurance could be a whole presentation in itself, but I need to keep it brief here to move on to some of the discussion around take-up of flood insurance. The major benefit of insurance is that it significantly reduces the financial impact on individuals and governments following a major natural catastrophe, such as a flood. As Guillaume mentioned earlier, it helps deal with the immediate cash flow situation. And this leaves the government not only free of providing rapid financial assistance, but means that it can focus on recovery and post-event response. From the perspective of a homeowner at risk of flooding, there is also a benefit simply from knowing that if flooding is to occur, they will be reimbursed quickly after an event. And in many insurance contracts, the agreement is to simply put the insured back into the position that they were before the event occurred. So that's a great reassurance to many individuals. Insurers themselves manage their finances in two ways. One is by mutualising or pooling risk. The mathematical law of large numbers means it's possible to come up with a relatively good estimate for the losses they will suffer across all locations that they insure. Whereas if you were to try and work that out for a single property, it's extremely difficult to predict what will happen year on year. And the second is by purchasing insurance for themselves. This is what we call reinsurance. Reinsurers are typically international companies that provide cover for many perils and locations worldwide, and hence they're in a position to pool risk at an even greater scale. This in turn offers individual governments the benefit that via the insurance market, they can access funding to provide recompense after events from the global financial markets, which end up then paying for some of the cost of damage that in the absence of insurance, the government might itself have had to bear. If we can move on to the next slide, please, Gwyn. The impact of this benefit can be illustrated by looking at an analysis that was carried out by Lloyd's of London following the Thai flood events back in 2011. This slide summarises that research and shows the companies that ended up paying for the insured portion of the losses in the Thai event. This is a list of nearly 50 companies among whom the loss was shared, and those companies didn't just cover flood in Thailand or even Asia. They had exposure in every peril in every corner of the world. So this is a case of the principle of having many eggs in many baskets applied. And this event, which was obviously very major for the Thai government and also for Thai Re, wasn't a particularly big loss-causing event for the international reinsurers who were involved in funding some of the losses. So there is a great willingness and a great capacity from the international reinsurance markets to provide post-flood event relief in terms of meeting the costs of damages. Next slide, please, Graham. Now, the take-up of insurance, however, is variable. And I spotted one of the questions that came up in the chat there being a comment as to why the insurance industry didn't pick up a greater proportion of the losses. And largely the answer to that relates to the take-up of flood insurance. So obviously in order for governments to benefit from the insurance markets after an event, there is a need for individuals to buy flood insurance. And if that doesn't happen, then the insurance community isn't able to help to the fullest possible extent after an event. We can see from the floods that I've described that take-up of insurance is very variable, ranging from around 95% in the UK to under 50% in Germany, and just over a percent point in Thailand for residential properties. As I mentioned earlier, it was much higher in the industrial properties that were inundated in Thailand. There are a range of factors that can cause higher or lower take-up rates for flood insurance. And it's notable that of these three countries, the UK is the one that includes flood as a standard in household policies, whereas in Germany and Thailand, it was purchased as an add-on policy extension that's paid for separately. Additionally, in the UK, most people will need to borrow money to buy a house via a mortgage, and most mortgage lenders will insist on insurance being in place before they will lend money. So property owners in the UK who require a mortgage aren't left with much choice about acquiring household insurance, and many people are forced into that position, and it will come with flood included within it. Flood frequency also has an impact, because if individuals see flooding happening nearby on a frequent basis, they are more likely to understand the potential benefits of insurance. In Germany, the German Insurance Association reported an unwillingness on the part of homeowners to pick up flood insurance cover prior to the 2021 event. But interestingly, there has been increased take-up of insurance following that event. So the event in itself has served as a warning to individuals who wish to be better placed to recover from flooding. Both of these rates are higher than in Thailand, where the insurance gap is very high. But it's worth saying that Thailand is already in a better position than many countries nearby geographically, and its market is growing steadily. Culture also has an impact on insurance take-up, and in the UK, having insurance is viewed as a normal state of affairs, and those who lack house insurance are generally viewed as being careless or incautious, whereas that's obviously not the case in many other countries. And it's fair to say that many in the UK and across Europe have been shocked to find that the take-up of insurance among homeowners in Germany was as low as 46% following the 2021 event. I'd now like to say a few more things about a couple of other topics that impact flood insurance take-up rates, and those are affordability and perceived benefit. So we'll start with affordability. There are two aspects to whether or not a policy is affordable. The first is the financial position of the individual. So a flood insurance policy that costs $100 or so may not require much thought from someone who is well off, whereas an individual in a poorer financial position may need to think very much harder about the potential benefits of that flood insurance protection versus other things that they might choose to spend that money on. The desire to purchase a flood insurance policy then in turn might relate to the perception of risk, which I'll come on to in a minute. But first, the second aspect of affordability is the cost of the policy. Now, this can be impacted by many factors, and as Guillaume mentioned earlier, in general, for the insurance industry to work, the sum of premiums gathered, the sum of those premium incomes need to be higher than the average annual cost of flooding. If we look at the diagram on the right here, this shows a couple of streets in the UK and illustrates areas that are prone to flooding in purple. So as you can see that even neighbours may have to be at maybe at a different level of flood risk as close as next door neighbours. And this can lead to them, if we look at insurance policies being related simply to the technical price, which is analogous in some ways to the average annual damage cost, we can see that some people may be living in a high risk area and would have to pay high amounts for their insurance premium, whereas others are in lower risk areas and may not be due to pay anything if the perception is that the risk is very, very low indeed. If we can move on to the next slide, Gwen. If we look at this countrywide using the UK as an example, we can see here in the top example that some properties may register a very high average annual damage and therefore may see a very high technical price associated with their policy. If I take an example here of a property that is worth $200,000, then I can come up with a calculation based on JBA's data that shows that the insurance price here will be just under $7,000. And that's obviously an amount that is unaffordable for many homeowners. Meanwhile, in areas where the risk is very much lower, then homeowners may decide, if they're given the option, not to pick up household insurance because their perception of the risk becomes very low. That's a potential problem for governments and for individuals. And the first problem is that their perception of risk may not match the reality. We've seen this happen in the UK prior to the 2007 floods, when many homeowners thought they were safe from flooding because they didn't live next to a river, but they didn't realise they were at risk from flooding directly from heavy rainfall, and that event particularly caused heavy rainfall flooding in areas that people thought perhaps weren't at risk before the event. There's also a nice example of this from the 2013 flooding in Germany, and if we can move to the next slide, please, Graham. This map shows the towns of Deggendorf and Fischendorf, located near to the confluence of the Rhine and Isar rivers. Prior to the 2013 flood, Deggendorf was known to be protected against a 100-year flood by the defence system along the Danube. Fischendorf was protected from the Danube by the same defence system, but many people didn't realise that it was also at risk from flooding on the Isar, which was further away than the Danube, but protected only by 30-year standard defences. In 2013, Fischendorf flooded when the Isar defences were overtopped, inundating many properties whose owners had believed themselves not to be at risk. As a result, they were unprepared to be flooded, and the losses they suffered were large as a result. I don't have any specific figures regarding the take-up of insurance in Fischendorf prior to 2013, but it's easy to see that this might be an example where flood insurance was not taken up because of a misperception of the risk. Next slide, please, Graham. So in the absence of other information, the history of an area has a big impact on determining whether or not individuals think they are at risk. Sometimes that history is helpful because there is the memory of a flood in the population, but sometimes there isn't because a particular location hasn't flooded in living memory. But other information is available, normally in the form of flood maps, either from companies like JBA or from governments, local authorities, or insurance associations. These maps enable homeowners to look at their property relative to flood extents and get hold of a more informed view as to whether or not they're at flood risk. The example shown here is one of JBA's maps for part of Leeds, close to my office, and highlights the area at risk to river flood in blue at the top and areas from surface water flooding in purple. We typically find that homeowners located close to rivers are well aware of what's a very visible risk, whereas individuals located on small streams or just in areas where heavy rainfall can pond and cause flooding may not be. If we can look at the next slide then, please, Queen. So coming on to the role of insurance. Earlier on, I described the very simple equation between the homeowner and the insurer, which says that the homeowner pays a premium so that the insurer will provide post-event compensation. But if we consider some of the various challenges I've raised in relation to flood since then, it's evident that some other considerations need to be brought into the mix to be able to enable a well-functioning insurance market that can maximise the benefit of insurers for homeowners and governments alike. So insurers may reasonably expect that homeowners take reasonable steps to prevent and mitigate damage, for example, moving belongings upstairs where possible prior to a flood and ensuring that their property is well maintained. That in turn means that homeowners need some awareness that they may flood, and that's something that the government can help with by providing information such as flood maps. Governments are also responsible for maintaining flood defences, and insurers likewise reasonably tend to expect that governments will ensure construction and upkeep of reasonable flood defence systems, so that it's not just the case of the insurer picking up the full cost of flooding because the government hasn't constructed defence systems. And finally, governments are also responsible for putting in place the legislation that's needed to ensure a well-regulated and functioning insurance market. And at the end of the day, the decision sits with the government as how to deal with problems such as affordability of policies and ensuring adequate uptake of insurance policies. Next slide, please, Guillaume. So how to make these aspects balance and ensure a working flood insurance market that can benefit the government and the individuals in a country to the maximum possible extent is a topic of much debate, perhaps particularly in Germany at the moment, where that 46% take-up of insurance among homeowners is viewed as far too low by individuals, the government and insurers alike. It's also the conversation that's happened in the UK over many years, because in the UK we may have a 95% take-up of insurance, but we still think that it should be higher and that everyone should be in a position to access post-event compensation from the insurance industry. One approach to this problem is to make flood insurance mandatory, either altogether or within any household policy issued, as is the case in the UK. This helps ensure that insurance and reinsurance capital is available to support claims to the maximum extent, but it can be difficult to put in place legislatively because it removes choice from the homeowner, and there is the problem that some homeowners may look at the cost of insurance and feel that is unaffordable. That can then lead to the question as to how premiums should be set. And I've talked a little bit about the variability in price if we look at a risk-based approach, where the price of an insurance policy is associated with the level of risk that the individual faces. Left to their own devices, insurers are likely to set flood premiums using a risk-based approach. But as I've shown, this can lead to unaffordable home insurance for some individuals in some locations. The opposite end of the spectrum is to enforce fixed premiums, perhaps according to house size or value, but irrespective of risk, so that everyone in the country pays into that pool of money that is then available after an event, or for the state to pay to provide a centralised source of insurance and then itself seek reinsurance. In this case, care is needed that individuals remain incentivised to adapt and to mitigate the risk where it's sensible to do so. One option that's being considered in Germany at the moment is an opt-out, where homeowners can choose not to take out insurance, but then must also sign an opt-out of any post-event assistance, hence ensuring that individuals cannot choose not to pay for insurance, but then still expect the government to pay for any losses that they see in a flood event. Nationwide insurance schemes are also an option, and one possible to consider is that used in the UK, where the Flood Re initiative ensures that homeowners located in the highest risk areas can obtain affordable insurance via the Flood Re scheme. All insurers pay into this scheme via a levy on homeowners insurance, and when an insurer provides cover for a property, it can choose whether or not to pass the risk to Flood Re for a fixed price. Flood Re then reimburses the insurer for any claim on the policy, and Flood Re protects itself via reinsurance. From the homeowner's perspective, there is no difference to taking out a normal insurance policy. They deal with their insurer as normal, but for those people in high risk areas, the Flood Re policy cost kicks in and the insurance cost is brought down to an affordable level. This scheme is working well in the UK, but nonetheless, the UK hopes to end the approach by 2040 and move back to a private market at that point. So for my last slide, Guillaume. In conclusion, I would like to say that insurance can significantly reduce the burden of losses on governments and taxpayers alike following a flood. There is appetite to offer flood insurance among reinsurers, but if we are to maximise the benefit that the insurance industry can bring, there is a need to narrow the insurance gap. And governments, insurers and homeowners all have a role to play in ensuring that that is the case. Guillaume, there follows 2 slides of references And after that, you will come to a disclaimer slide, and finally the end slide that I think is there to cover the questions. Thank you everyone for your time.
Thank you, Jane. Thank you very much for the presentation. Now I will pass it to Ian Wood to moderate the discussion. Thank you.
Thank you, Guillaume and Jane. We've got a few minutes now available for discussion. So I'll start with the questions that have been posted in the chat box, but also remember there is a Q&A box that's available, but we are limited at time. So we'll try and keep to the end time here. So I'm just going to go firstly to a question from Anthony Zola. And Anthony says, I live in Pattutani province in central Thailand. I was not able to live in my house for 2 months following the disastrous flood since 2011. And he makes the comment that it is impossible to purchase flood insurance at any price, he's finding. And so why is this? The question is why after these floods, and he wants obviously to be able to insure his property. So but why would that be the case? For Jane.
Thanks. So I think that's going to come back to this question of how the government might decide to look at flood insurance. If you are living in a heavily flood prone area in the middle of Thailand that was flooded in 2011, first of all, you have my sympathy for the damage and the time and the difficulties you faced back then. And also you have my sympathy for the lack of insurance you've been able to find since. I think any insurer looking at that area is now likely to set high prices unless the Thai government chooses to intervene and think about schemes that will make insurance affordable in all areas. So the insurer will simply look at what is the risk and how much money might I lose on your policy in this location. And with 2011 in mind, they're likely to take a view that that's a high likelihood of quite a high loss. So that's the reason that the policy is priced so high at the moment. And I'm afraid it's probably a question where the government needs to have a think about how to set up the market in Thailand so that people living in high-risk places don't have to pay those very high premiums. That may lead them to look at something like the flood re-scheme that I've mentioned in the UK. We have similar problems of people who live in very high flood risk areas and see unaffordable rates for household insurance, but the flood re-scheme initiated by the government has come in and kind of capped the cost that you would have to pay for a flood insurance policy, and therefore made it possible that even if you live in a high risk area, it is possible to get flood insurance. So there are ways around it, but it will need government involvement.
Difficult question, isn't it? Thanks, Jane. It's a difficult issue that many countries face and many people do. It's the relationship between the risk and who pays the cost for that risk is a difficult one when it comes to housing. Much different to many other sectors, I think, in insurance. I'd actually like to give Jeff Wilson, our project officer, a chance to raise a question that he's had. But Jeff, you can jump in if you want to actually add any more to the question. But the question coming from Jeff is relating to the operations of ADB and the developing member countries that ADB operates in. The question is what data and information would be most useful for the insurance industry? What does the insurance require in terms of information to be able to exist, to be able to improve its level of coverage, to be able to improve its level of functionality through the DMCs?
Yeah, if I can just clarify it. What data or information is most lacking and most needed from the insurance industry with regard to our DMCs? Thanks, Jane.
Thanks, Jeff. So the insurers need two things, I suppose, and one is the insurance setup in the country and, as I say, the input from the government that is that whole scheme as to how the insurance industry is going to work and how society is going to deal with these losses that occur. Once that's in place, the insurers need to be able to come up with some sort of estimate of what the risk is at a location or across a whole country. And that brings them into the territory of needing things that we call catastrophe models that estimate the severity and frequency of events. Now, the sort of information that we need to be able to feed into those models is things like the location of the property, and that comes down to the exact building outline if possible, or latitude, longitude, but often that information isn't available at the moment. And then once we know where the property is, we need to be able to get hold of information on the property itself. So what kind of structure is it? How tall is it? Is there any flood prevention measures in place? What's the value of the property? What's the construction of the property? So all of that sort of information helps insurers estimate the sort of risk that they're facing at that location, and I would say is one of the big bits of information that needs to feed back to insurers to help them offer insurance. But as I've also said, that's a bit of a subset to insurers setting up a system within society that means there's a decision there and a clear allocation of who will be paying losses and how the insurance industry is involved in that.
Thanks, Jane. If I can just push you a little bit further, what's the role of remote sensing in collecting some of that data?
So remote sensing data can increasingly help us look at things like flood extents and look at property locations. But if we think about property locations specifically, remote sensing data will tell me where all the properties are, but it won't tell me where the one property that someone's requesting be insured is. So it would enable me to come up with, say, an estimate for a market-wide loss in Thailand, because I can look at where the value of every property is distributed. But if it's a case of underwriting and providing the gentleman who spoke earlier with flood insurance for his property, it doesn't help tell me where exactly his house is.
Jeff, thanks. Jane, I think we're just going to squeeze in one last question, just if we can make a quick answer to this one. This comes from Tasneem Razi Malik. And the question is, how can a person with low income get his or her household insured by insurance companies? So the question is about affordability of insurance for low income people.
Yeah, and I think that's another question that's pointing right into the whole question that is here about how insurance is set up in countries by governments, because I can understand that if it's a purely private market and the government isn't thinking about how it can run the insurance industry, then it's possible that someone with a low income who's in a high risk area can look at a premium cost that's unaffordable. So again, there's a need to perhaps lobby governments to think harder about insurance and really about how they can deal with that, about getting an increase in the insurance take-up, because that means that risk is shared, and people who are perhaps better off or at lower risk are also putting money into that pool of premiums that's available there to pay after an event. So there's an angle of mutualisation in there that says if it's only people at high risk who are putting into the pool, then that's less money to be available and therefore premiums are less affordable.
Again, it's a complex issue, isn't it? Unfortunately, we're running out of time, so I'm just going to move to wrap up the discussion. So I'll just like to, well, actually, I mean, we've got more questions than we can answer today, but we do have one more bite at the cherry. We have one last chance, which is our next webinar, which will be Tuesday of next week. And so in that, I would like to get some of these big issues. This is much more open discussion type panel session. And so there's a kind of question that's relevant to both Guillaume's presentation and Jane's, and hopefully we can pick up on this one. And this is about the economic rationale for flood risk management. How can we, what is the right level of expenditure for a country when it comes to expenditure in flood protection compared to the average annual losses, compared to the GDP of the country? These are really important questions. So we will, if you didn't get your question answered today, maybe there'll be an opportunity next week but also we will try to get some of these bigger issues about what is the right amount to be spent on flood protection. So just in wrapping up, I'm just going to summarize a few kind of points that we addressed really. In Guillaume's presentation, one of the key points that was made was that more assets requires more commitment. So that if we can spend a lot more money on our flood protection infrastructure, but at the same time, it commits us to more expenditure on operations and maintenance, a key issue that shouldn't be overlooked. Secondly, from Guillaume, we heard that kind of almost counterintuitively that these small, frequent, small damage floods that occur every year or every second year, every third year, they actually have a greater impact on the overall annual average losses that are calculated as part of economic analysis. And so it's something we're thinking about, that often small measures will count, and small measures will count in terms of reducing losses, and it even comes into flood forecasting as well. Flood forecasting and warning can often help with saving these losses that occur in these smaller events. So that's an important issue. And finally, from Guillaume's presentation, leading into Jane's is this concept that a dollar is not a dollar, that a dollar in the immediate post aftermath of a flood event is more prized, more highly valued than a dollar in a kind of normal time. So that's really the principle of insurance, the insurance that gives us this immediate access to funds. And so therefore, there is this real benefit to insurance. It's a complex issue. We've heard from Jane about these issues of parity, about sharing risk, about the cost of risk in one location compared to another, the difficulties of implementing that across at a national scale with government support. And so therefore, on the one hand, we have the insurance has this tremendous benefit of providing this dollar immediately. And the other hand, we have this sort of complex situation involving politics, involving cultural issues, involving uptake by people from different backgrounds, different economic levels. So all of that tells me that even though insurance is difficult, it needs to be solved. It needs an issue that really needs to be addressed, and really looking forward, whether it's in our DMCs, our countries in Asia, or whether it's across the globe in other countries, insurance is a critical issue that it needs to be addressed, even if it is complicated. So with that, we are out of time. So I want to thank you, our presenters, Jane and Guillaume, for your presentations. I want to thank everybody for their participation in the discussion. Guillaume, can I ask you to put up just click ahead on the presentations, because I'm going to talk a minute about what is happening next week. So as I alluded to before, next week is this kind of general topic on IFRM outlook and ways forward. So we're going to step back and try and focus on the big issues about flood risk management sector in Asia. And rather than hear us consultants talk, we're going to really open up the floor to an expert panel. So we've got about 8 panelists from different backgrounds, mostly from within Southeast Asia, from different levels of experience. We've got men, we've got women, we've got technical professionals, we've got managers. So we've got a wide cross-section of people to be able to offer their opinions. And so we'll have this whole 90 minutes as more or less a question and answer discussion period. So really, we urge you to come along to our presentation next week, participate in the Q&A, encourage your colleagues and friends to participate as well. So we're hoping that we can bring together some of these big issues and have a really good discussion about this. So with that, we'll see you next week. Thank you very much to everybody.
Thanks, Ian. Thanks, Lorena.
Okay.
Thanks, team.
Thank you.
Thank you.